Here's a paradox that's baffling economists and investors alike. Stock markets are hitting record highs even as traditional economic indicators signal trouble. Imagine a world where joblessness is rising, workers are more pessimistic about their futures than in years, and prices are creeping upward. Meanwhile, the U.S. government's budget gap is widening, and consumers are tightening their belts. Yet the stock market keeps climbing. How does that happen? Let's unpack this puzzle. The first piece of the story is the surge in unemployment. Recent surveys show workers are increasingly worried about layoffs and job security. That's not just a numbers game. It's a psychological shift that can ripple through entire industries. For example, if tech companies start cutting staff, the ripple effect could hit everything from coffee shops to car rentals. But here's where it gets controversial. Some argue that rising unemployment doesn't immediately translate to falling stock prices. Why? Because markets often look ahead. If investors believe the worst is already priced in, they might buy stocks in anticipation of a rebound. Then there's inflation, which is quietly ticking upward again. While not yet a full-blown crisis, this upward trend raises questions about the Federal Reserve's next moves. Will they raise interest rates to cool things down, or wait and see? This uncertainty creates a tug-of-war for stock prices. On one hand, higher rates make borrowing more expensive for companies. On the other, markets might rally if investors interpret rate hikes as a sign the Fed is in control. And this is the part most people miss. Corporate profits often outpace macroeconomic trends. Even if the broader economy is slowing, companies with strong balance sheets or innovative products can still grow, driving up their stock prices. But let's not forget the elephant in the room, the unresolved questions hanging over the economy. What will happen to President Donald Trump's proposed tariffs? Will they spark a trade war or force domestic industries to innovate? How will the Fed balance inflation concerns with the risk of a recession? These unknowns create volatility, but they also open doors for speculative trading. Some investors are betting on specific outcomes, while others are hedging their bets with defensive stocks or alternative assets. Now here's a thought-provoking question for you. Are we witnessing a disconnection between financial markets and the real economy? Or is this just a temporary phase where optimism outpaces reality? Could it be that the market is rewarding companies that have mastered cost-cutting and efficiency, even as the broader economy stumbles? Share your thoughts in the comments. Do you think this trend is sustainable, or is it a ticking time bomb waiting for the next economic shock?